Two people, same age, same city, same $50,000 sitting in the bank. 20 years later, both of them are wealthy. But one spent hundreds of weekends dealing with tenants, repairs, and unexpected expenses, while the other barely spent a few hours a year thinking about his investment. The shocking part? They ended up with almost the same amount of wealth. So, if both paths can lead to financial freedom, why is the real estate versus index funds debate still one of the biggest arguments in personal finance? The problem is that most people choose a winner before they look at the numbers. Real estate investors talk about cash flow, leverage, and tax advantages. Index fund investors talk about diversification, simplicity, and compound growth. Neither side is necessarily wrong. The problem is that both sides often leave out the details that make their favorite strategy look less attractive. To find out what really works, we need to look at the full picture, not just the highlights. Let's imagine two investors starting from exactly the same position. The first investor uses his $50,000 as a 20% down payment on a $250,000 rental property. The second investor puts the same $50,000 into a low-cost total market index fund and continues investing a few $100s every month. At first, real estate looks far more exciting. Rent checks show up every month, the property feels tangible, and ownership feels rewarding. Meanwhile, the index fund investor simply watches numbers move up and down on a screen. It feels boring. But investing isn't about entertainment, it's about results. For the first few years, the real estate investor feels like he's winning. Rent is coming in, property values are rising, and equity is building. But then reality starts showing up. Property taxes increase, insurance costs rise, maintenance issues appear, a water heater breaks, a roof starts leaking, a tenant moves out, leaving the property vacant for a month. Suddenly, the cash flow that looked amazing on paper starts shrinking in the real world. Meanwhile, the index fund investor keeps doing the same thing he has always done, investing consistently and staying patient. Now, let's look at the evidence. Real estate has one massive advantage: leverage. With only $50,000 invested, the investor controls a $250,000 asset. If property values rise, the gains are magnified because the appreciation applies to the entire property value, not just the original investment. That's one of the biggest reasons real estate has created so many millionaires. But index funds have a powerful advantage of their own: compounding. Every gain begins generating new gains, and over time, that growth can become extraordinary. After a decade, the real estate investor may have built substantial equity, but the index fund investor's portfolio may be surprisingly close in value. After 20 years, both investors could realistically end up with hundreds of thousands of dollars in wealth. Different paths, similar outcomes. Of course, neither investment is risk-free. Real estate comes with vacancies, expensive repairs, difficult tenants, rising taxes, and debt. A single major repair can wipe out months of profit. On the other hand, index funds come with market volatility. During major crashes, portfolios can lose 30% or more of their value in a short period of time. Many investors panic, sell at the worst possible moment, and miss the recovery. In both cases, the greatest threat is often not the investment itself, but the investor's reaction to challenges. So, what's the conclusion? If you're comfortable using leverage, managing properties, and handling unexpected problems, real estate can be an incredible wealth-building tool. If you prefer simplicity, diversification, liquidity, and a hands-off approach, Index funds can deliver outstanding long-term results with far less effort. And for many successful investors, the best answer isn't choosing one or the other, it's combining both. Building equity through quality real estate while consistently investing in broad market index funds creates multiple engines of wealth working together. At the end of the day, the investment that wins isn't the one that looks best in a YouTube thumbnail. It's the one you can stick with for decades. Because wealth isn't built by finding the perfect asset. It's built by staying consistent long enough for a good strategy to work.